Hi, I'm Jeff Tucker, Principal Economist at Windermere Real Estate, and these are the numbers to know right now. The first number this week, 7%. That is about the typical interest rate on a 30-year fixed rate mortgage right now, according to both Freddie Mac and Mortgage News Daily. It's also almost a full point higher than it was just 4 months ago in mid-September. I should add that the daily data have been very volatile lately, with rates jumping up and down by sometimes 10 or 15 basis points. But in the bigger picture, this is the first time since last May that Freddie Mac's weekly survey showed rates above 7%. So, the question this week is why? What's going on here? Well, for the proximate cause, we can look at our second number to know right now, about 4.6%, which is the latest 10-year Treasury yield as of January 17th. Mortgage rates tend to track quite closely with this key benchmark long-term yield, plus a spread of a little bit more than 2 points. Now, there's a bit of a puzzle here, though. The Federal Reserve has been cutting the federal funds rate, an ultra short-term overnight interest rate, and they started with a supersized half-point cut back in September, and then two more quarter-point cuts in the rest of 2024. So why are mortgage rates and 10-year Treasury yields rising at the same time that the Fed is actually cutting rates? Well, you're not alone in being surprised by that. This is unusual, historically speaking. This is a great chart from Torsten Slok, chief economist at Apollo Global Management, who recently flagged that this is a very unusual divergence. The blue line here shows the average of past cycles in which the Federal Reserve was cutting that overnight Fed funds rate. It shows that historically, yes, the 10-year Treasury yield also tends to fall during a rate cutting cycle. That's that blue line there. But in green, it shows this time and how this time is quite different. Interest rates have risen. That 10-year Treasury yield has risen about a full point in those few months since the Fed began cutting interest rates. So why would that be happening? Well, I think the answer comes down to the fact that we've gotten a bunch of positive economic news in the final few months of 2024. A piece of that actually, I think, was the Fed cutting interest rates by half a point to start the rate cutting cycle. It showed a willingness and an urgency by the Fed that they didn't want to fall behind and try to play catch up with an economic recession unfolding like they typically have in most past rate cutting cycles. They're willing to act quickly to try to do what it takes to prevent a recession from kicking off this time. And I think demonstrating that willingness to act is helping to raise prospects for economic growth and inflation over the next couple of years. So that's feeding into the 10-year Treasury. Another major factor is our next number to know this week, 256,000. That's the number of jobs added in the December jobs report. That makes 3 out of 4 really strong months of data from the jobs report that we got since the Fed began cutting interest rates. Really all of them except for October, which was impacted by hurricanes. So that is showing that the economy is not actually falling into a recession as some had feared heading into September. And then finally, looking at the other side of the Fed's dual mandate, inflation, well, the cool down in inflation has also stalled out. So this would be our final numbers to know this week, 2.9%. That's the year-over-year change in the consumer price index right now, and 4.8%, which is the annualized monthly gain in December of the CPI. Now, that monthly gain was heavily impacted by some volatile components, including energy. And so all in all, this CPI report basically showed we still haven't kind of killed inflation. The Fed hasn't yet put out the fire of inflation that's running above its 2% target. I added that as a dashed gray line on the chart here. So putting all of that together, a surprisingly resilient labor market, inflation being stubbornly unwilling to get all the way back down to 2%, and that willingness to do what it takes from the Fed all combines to a picture of looking ahead, an economy where both economic growth and probably inflation are going to keep running a little bit hot. So that is feeding back into mortgage rates. And unfortunately, I think that's the main reason. Right now, we're somewhere in the ballpark of 7% for a 30-year mortgage. All right, thank you so much. That is everything I've got this week. Thanks for watching, and don't forget to subscribe.